We are going to talk about the underlying determinants of global currency status. It is an issue that has been topical for a very, very long time, with widely diverging opinions. The literature has provided, different views. I think now we have 10 years of experience with the euro. And I think there is very much a link with what we have discussed until now, and I am sure before I came, things must have also been alluded to. I mean, the link with the current crisis, and this as a defining moment also for the international role of the euro, and I would say for the international role of the euro area more broadly. So the way we come out of this of the present crisis, I think, will influence a lot. I mean, the medium to long-term prospects of the euro in the international monetary system, and the euro area in the system of global governance. I think this is a quite plain conclusion. So we have a very distinguished set of speakers. Since we have PowerPoint presentation, I'm not going to call them here to the stand. They will come later for Q&A. So we start with Kristin Forbes, who teaches at the MIT Sloan School, who was member of the Council of Economic Advisors for International. And Kristin will talk about the financial network effects and deepening. Since we are running late, and in order to leave some time for the debate, I would ask the speaker to stick to the 12 minutes presentations. I know you are all freezing because 12 minutes go quickly, but make your best effort. If you don't do it alone, I will help you. Kristin, you have the floor.
Okay, thank you very much. As you can tell from the list of the different topics the panelists will cover in the next hour or so, there's many different determinants of global currency usage. I've been asked to focus on one, a demand for a country's financial assets, the importance of financial deepening and financial liquidity. And I'll admit, I had a hard time the last 2 weeks as this crisis has unwound, trying to shift gears and focus on demand for the euro and European demand for European financial assets. But as I sat and put together these comments, I realized that these are not two separate topics. How Europe responds to this financial crisis, what happens to its financial markets, especially the decisions made by policymakers, are going to be critical in determining the longer-term demand for the euro and European assets. So these two topics are not as separate as you might initially think. But before getting to that, which I'll talk about at the end of my 12 minutes, I want to do three things. First, take a step back, look at the demand for U.S. assets over the past few years, talk about what determines foreign investment in the U.S., and then from studies on this topic, draw some lessons for demand for European assets and link that to the financial crisis. So first, not a surprise to any of you in this room, there's been an insatiable demand for U.S. assets over the last few years. Just a quick review of the numbers because they're so astounding. 2007, so as this financial crisis was building up in the U.S., there were $2.1 trillion of new capital flows into the U.S. from abroad. That doesn't count any asset sales that happened. That's $2.1 trillion of net new money coming into the U.S. This obviously funded the U.S. capital outflows plus the U.S. current account deficit. From 2000, this was not a one-year event. From 2003 to 2007, there were $7.8 trillion of new foreign investment flows coming into the U.S. This is over $5 billion a day of foreign money coming in buying U.S. assets. And the numbers are just astounding. Even after the subprime crisis started to really unfold, the money still kept coming into the U.S. at a slightly slower pace. But, for example, in the first quarter this year, $400 billion of new capital flows coming into the U.S. in purchases of U.S. financial assets. Fortunately, we don't have the data for the last couple months. But bottom line is this huge demand for U.S. financial assets has been a key support for the U.S. dollar and a key factor driving the value of the dollar. Where is all this money going? Here's a graph of average of the use of the money from 2003 to 2007. There's a sense that a lot of the money coming into the U.S. by foreigners is going into U.S. Treasuries, and certainly some of it is going into U.S. Treasuries, but that's really only a small fraction of the money coming in. U.S. Treasuries are only 5% of private sector of the total investment, and 16% in total if you combine private sector and official sector investment, which is the right. But 22% of the money coming into the U.S. is in corporate bonds. About 17% is in FDI and equities. So there really are a diverse use of the money coming into the U.S. It's not just treasuries. Not surprisingly, as a result of these huge capital flows, over $5 billion a day into the U.S., foreigners now own a substantial share of major U.S. asset classes. For example, foreigners now own 11% of U.S. equities, 24% of corporate debt in the U.S., and 57% of the marketable U.S. treasuries. That's pretty astounding numbers, and again, reflects the importance of foreign demand in the U.S. for U.S. assets in propping up the dollar. So what determines foreign investment in the U.S.? Why are foreigners willing to put over $5 billion a day into the U.S.? So I'm going to go through a couple potential explanations. Well, one reason is that foreigners earn high returns on the U.S. investments. If you listen to any U.S. Treasury Secretary speak, you'd hear them make this implication or imply that this is the fact. Put a quote from Secretary Posen, because he's the most recent Treasury Secretary: investors can earn an attractive return on their capital in the U.S., but since he's been beat up enough the last few weeks, I also put up a quote from another Treasury Secretary, and you can all pick your favorite Treasury Secretary. They all have speeches and regularly say things like, the U.S. is a great place for foreigners to invest. You'll earn a high return. Now, this is important because there is quite a bit of academic evidence showing that investors chase returns. So if foreigners had been investing in the U.S. and earning high returns, that's a reason to expect them to continue to invest in the U.S., because they would expect to continue to earn those high returns. So is that the case? There's a lot of different ways to cut the data, but no matter how you cut it, you get something like this. This is just private sector investment, so let's take out governments, because governments can invest for a whole host of reasons other than returns. The red bar is the return for each asset class that Americans earn when investing abroad. The blue striped bar is the returns that foreigners have earned in the U.S. for each asset class. You see a pretty striking pattern. In every asset class, foreigners have earned much less investing in the U.S. than Americans have earned abroad over the last 5 years for which there was data. And this pattern continues if you do this in individual years. This pattern holds even if you adjust for currency movements. It also holds even if you make some rough adjustments for risk. So consistently, again, no matter how you cut the data, you see that foreigners investing in the U.S. have earned actually quite low returns versus what they would have earned if they kept their money abroad or outside the U.S. So clearly foreigners are not investing in the U.S. because they've earned high returns year after year and are chasing those returns. It's another reason foreigners might be willing to invest over $5 billion a day in the U.S. Another important reason could be it's just a natural reduction of home bias that we've seen around the world. Just individuals want to diversify their risks. So not surprisingly, they want to invest in one of the largest market in the world just to diversify the risks across their investments. So next I'm going to look at our countries are over or underinvested in the U.S. versus what a well-diversified portfolio would show. So what I'm going to do is compare the share of foreign investment in the U.S. versus the U.S. weight in the global market portfolio. So the top line shows the U.S. share of the global market. So the left column is equities. U.S. equities are about 36% of the global equity market. And the right, U.S. debt markets, that includes corporate agency and government debt, are about 38% of global debt markets. So if investors held a well-diversified portfolio, if you use just a very simple portfolio allocation model, very standard in the finance literature, no fancy assumptions, investors should hold 36% of all their equities in the U.S., and they should hold about 38% of their debt in the U.S., no matter what country they're from. Now, in fact, the line that says mean, that's the actual average holding of U.S. equities or U.S. debt for countries around the world. So on average, foreigners only hold 4% of their equity investments in the U.S., and they only hold 11% of their debt investments in the U.S. The medians are even lower. So what this suggests is that most countries around the world still are not very diversified. They still do not have very much exposure to U.S. markets versus what you would expect according to just standard portfolio diversification models. Just one interesting side note. On the maximum line, that's the most exposure any country has, there are about 3 countries that are technically overexposed to U.S. debt. The highest one is China. Just a little side note. But the bottom line from this is that most countries are underexposed to the U.S., and that could be an important factor driving investment in the U.S. Countries are just reducing their home bias, they're diversifying their portfolios, and that's leading to a natural inflow into the U.S. and a desire to purchase U.S. assets. So what are some other factors driving U.S. capital inflows and driving this $5 billion a day into the U.S.? Quickly talked about return chasing, showed that's probably not a factor because foreigners have earned pretty disappointing returns in the U.S. over the past 5 years. Diversification could be a factor supporting capital inflows. More quickly, for a few other factors, another key one that's gotten a lot of attention in the academic world is financial market development. And the main idea is that there's countries around the world, such as China and the Middle East, that are generating huge surplus earnings and huge savings, and they want to invest this somewhere. But their own countries have very undeveloped financial markets, very small markets, not very liquid, very inefficient markets. So people or governments in China and the Middle East want to invest this money somewhere that has deeper financial markets, more liquid financial markets, safer financial markets, and so they send the money to the U.S. So it's really the fact that the U.S. has the largest, most developed, most liquid financial market in the world, which has attracted a large part of this capital inflows. Another reason foreigners might invest in the U.S. is because of trade or closeness links. Basically, there's some evidence that when you trade more with a country, you tend to buy more of their financial assets. There's also evidence that when you're closer, you buy more financial assets. And by closer, I don't just mean distance. I mean closer in terms of ties, like talking the same language, sharing a colonial heritage, cheaper cost of communications. Any of those factors could make it easier to buy U.S. assets and increase the demand for U.S. financial assets. And then finally, strong corporate governance. Don't smile right now, but there was a belief that the U.S. had the gold standard of corporate governance and that this could have drawn an investment. That investors were happy to invest in the U.S. because of the strong institutions, what was believed to be good accounting standards. At least they knew their assets would not be confiscated by the government, and that could draw investment. So which of these factors is actually important? I've done a big empirical project trying to sort out the importance of these 5 different factors to find out which, again, is really important in driving this $5 billion a day into the U.S. I'll skip all the equations, all the details, but just tell you the bottom line of this analysis. The bottom line, and I'll admit this surprised me quite a bit, but the bottom line, what shows up strongest and most clearly in this empirical work, is that it's the relative development of the U.S. financial markets, which has been the key driver of foreign capital into the U.S. from all around the world. Countries hope to take advantage of the more developed, the more liquid, the more efficient financial markets in the U.S. And to give you a sense of the magnitude of this effect, I took the estimates from this paper and applied it to China. So China held $894 billion in U.S. bonds at the end of 2007. Taking the estimates from this paper, let's assume that China increased its private bond market capitalization to GDP, so basically developed its private bond market, so that it's comparable to the size of South Korea's bond market, at least as of 2006, before all this financial market turmoil hit. If China did expand its own financial market that much, that would mean less need for the Chinese to send money to the U.S. and invest in the deep U.S. financial markets, and that would reduce China's holdings of U.S. bonds by $250 billion. So that does suggest the magnitude of this effect could be very large, that the developed U.S. financial markets, the liquidity of the U.S. financial markets has been critically important in attracting this investment into the U.S. Just a quick summary. So in the empirical analysis, I found financial market development the most important factor driving countries to invest in the U.S. I also find a small role, or a moderately important role for trade and closeness. Countries that trade more with the U.S., that are closer through cultural ties, speaking the same language, also tend to send more money to the U.S. And then also find a small role, although only for equity markets of return chasing. Investors do tend to send their money to countries which have recently hit higher returns in their equity markets, but that doesn't apply to bond markets. So what's all this mean for the euro? Oops. What's all this mean for the euro? So the lesson from the study of what drives this foreign investment in the U.S. and demand for the dollar because of demand for dollar assets, key thing is financial market development. European bond markets have been growing in size. That suggests it will attract more and more money into the European bond markets. They're still smaller than the U.S., but they're closing the gap slowly. Equity market capitalization, though, in Europe is still roughly half of the U.S. So European equity markets are still nowhere near the size, the liquidity, the depth of the U.S. markets. I think the key thing, though, is what's next, or how is Europe going to respond to this financial crisis? Not only how will the markets perform, but how will regulators respond? How will policymakers respond? Right now, the response really is reminding us that European markets are separate markets. Each regulator, each government is responding individually. So it is not sending out the impression that there is one large European capital market, or especially one large European equity market. And I think this is going, if this is the approach that continues to be followed, will send a very strong signal that the European markets are not one large combined liquid, efficient, deep market, and that will in turn detract from the capital flows coming into Europe. If such a key factor driving capital flows is the search for a single large, coherent liquid market. Another factor which the empirical analysis suggests is important in determining demand for a country's financial assets, trade and closeness. I don't think there's any major changes coming there, and I know one of our other speakers is focusing on trade, so I won't say any more on that given the short amount of time we have. One other factor that appeared to be important in driving demand for financial assets is return chasing, especially in equity markets. So how does the European market hold up in that sense if investors are chasing returns? Up until recently, European markets were outperforming U.S. markets. For example, from 2006 to 2008, the return in the Euro First was substantially higher than the S&P. But since this crisis is around, in this year, returns in Europe are lower. So that actually suggests there could be less demand for European assets going forward if returns in Europe continue to underperform the U.S. But again, given what's happening right now, I don't dare make any prediction about relative returns going forward. And then the final factor that could be important in driving capital flows is this reduction in home bias, this desire to diversify across countries. I found that actually hasn't been that important in driving demand for U.S. assets. And in Europe, not only does this analysis suggest it may not be important, but actually foreigners are more exposed already and hold more European assets than they hold American assets. So the bottom line in red is the chart I showed you earlier. U.S. equity markets are 35.8% of global equity markets. The average holding of U.S. equities, though, in portfolios of different countries is only 4.8%. So that means divide 4.8 by 35.8. Foreigners only hold 13.5% of the optimal asset holdings of U.S. equities. Foreigners similarly only hold about 24.9% of U.S. debt versus the optimal portfolio holdings. If you look at those numbers for France and Germany, though, the numbers are already quite a bit higher. So that suggests that most countries around the world already have quite a bit more exposure to European equity markets and debt markets than they do to U.S. markets. And so if you're counting on reduction in home bias, diversification to drive more money into Europe, I don't think that's going to be an important factor. So to conclude, the bottom line from all this analysis is that I think how European financial markets emerge from the current crisis is going to be the key determinant of future investment demand for the euro. So if these markets emerge looking like one coherent, large, liquid market, that will attract quite a bit of investment. And that's where right now how policymakers respond. If they treat Europe as one market instead of a collection of individual markets with different regulations, different backstops, they continue to behave this way. This suggests that there will not be a large increase in investment demand in the Eurozone, and therefore not a large increase in this one source driving demand for the euro. Thank you.
Kristin, thank you very much. I'm sure that everyone, as we go through these papers, it was very natural for the first one. I'm sure we will have it also for the next ones. One processes naturally the papers, the findings in the light of what is going on in the world now. I think one point that you make, I think it's important, is how we come out of this crisis. I mean, one possibility here is that we come out on the high side and we take the opportunity, as every crisis provides opportunities, to come to a deeper and more unified markets. Then you can take the more skeptical view, and one of the risks that we actually having is in Europe is more nationalization and risk of a balkanization of financial markets, which actually would run into the completely opposite direction. So with this, we can move to the second paper. I call on Philippe Martin of Paris School of Economics. Same rules of the game. You are going to talk about international trade in financial assets. You have the floor for 12 minutes.
Okay, thanks. So actually my talk is going to be related to what Kristin was talking about, with a little bit more focus on the effect of the euro on cross-border asset holdings. So as you may remember, there was quite a lot of debate when the euro was launched on the effect that the euro would have on trading goods, and there's been quite a lot of academic literature on this. And if we look at the most recent results, the estimates are positive, but actually quite modest impact on trading goods. Now, one aspect that I think is emerging is that actually the euro effect on trade in financial assets actually seems to be much more visible, even though it might be a little bit too early to have definitive answers on this, and impressive. At this point, I'd like just to take a pause, because there is in some sense an implicit or explicit assumption in this conference, and maybe even in the title of this conference, that bigger markets are always better markets, that we need to compete to get these financial activities, and that the euro is part of this competition to get big financial markets. It's maybe true, and I can think of several economic rationale for this, that it's better to have more supply of risky assets, to have more liquidity, etc., etc. However, I think at this stage today, I think we should rethink a little bit more about the rationale for this competition to attract financial activities and financial markets. I don't have a strong answer. I just think that we should pause and certainly ask a little bit more about whether the euro was made indeed for this type of competition to attract financial markets. Now, I'll talk a little bit about also some of the possible implications of the findings I will report on the geography of financial markets. Okay, so if we come back to why is it that the euro can affect cross-border trade in assets, there are several mechanisms, and I'm not going to go too much into detail. I guess you know about them. The first one is obviously the elimination of currency risk. The fact that in Europe many institutional investors have local currency mandates, so that with the euro automatically, mechanically, these are relaxed. That liquidity-related costs may fall with the euro, and more generally that there are economies of scales on financial markets that are going to play in favor of the euro. All this, in some sense, can be thought of or interpreted as the fact that with the euro you have had lower transaction costs for cross-border trade in assets. Transaction costs here in a very broad interpretation, not the interpretation or definition that I guess most market participants would have. It's a more broader interpretation in the sense of any impediment that make it more costly and more difficult to buy and trade foreign assets. Now, I think it's useful to disentangle the effect of the euro in terms of lowering transaction costs on financial markets on who is going to be affected by this. One is that the first one might be that for all investors, whether they are insiders or outsiders, it's now cheaper, or transaction costs have fallen, to buy euro area assets. And here one can think of this as the euro as being a unilateral financial liberalization process. The second one is that there may be an additional fall of transaction costs if both investors are in the euro area, meaning both the buyer of the asset and the seller of the asset. In this case, this type of benefit in terms of lower transaction costs to trade euro assets only pertain to investors in the euro area, and that's the reason why we can call it a preferential financial liberalization. So let me give you some numbers on these two effects, and first on the unilateral effect. It's based on empirical work, which in some sense shares quite a lot of the methodology that Kristin has also used. Empirical work with Nicolas Cœur-d'Acier at the London Business School, where we use some IMF and BIS data on cross-border holdings of equity, bonds, and banking assets. I'm only going to talk about the equity and bonds. Now, what we find is a large portfolio bias for euro assets. Investors, and here this is the first one again that pertain to both insiders and outsiders, investors hold 60% more equity, euro equity, 100% for the bonds position than predicted by the usual determinants of cross-border asset holding. So here what we use are what is called the financial gravity equations, where you try to determine, to analyze what are the determinants of cross-border asset holdings. Kristin has talked about some of them: return, the distance between countries, the market capitalization, whether those countries are financial centers, etc., etc. And then what we try to do is isolate the effect of the euro. Of course, I wouldn't go so far as saying this is only the euro effect. There may be other things that are correlated with the euro, but we try as much as possible to isolate this effect of the euro. Now, our estimate is that this bias for euro equity and bonds is consistent with transaction cost, again, with a very broad interpretation, lower in the euro area of around 15%. Note that even though transaction costs, this decrease in transaction cost to buy euro assets is around the same for bonds and equity, the effect is larger for bonds than equity, and the simple reason is that bonds are better substitutes, so that a given fall in transaction cost will have a larger impact on assets which are better substitutes, in this case bonds. Now, as a preferential liberalization, we also report some numbers. Here we also find a very large effect, maybe too large to believe in some sense. In the early literature on the effect of the euro on trading goods, there were really big quantitative effects of the euro on trading goods. Maybe we are in the early steps of this literature, and maybe these are large effects. But there are also other papers, for example, by Phil Lane and Pisani-Ferry, who find similar numbers, large numbers. So in this case, euro increases bilateral holdings when both investors, the buyer and the seller of the euro asset, by 150% for bonds and 45% equity, and we find a relatively large 13% transaction cost fall due to the euro. Okay, now, if one believes, at least qualitatively in these results, maybe quantitatively one has to do more on this, then the next question is whether euro has had a diversion effect on financial markets. Now, if you have lower transaction costs in euro financial markets relative to other financial markets, there's not been an increase of transaction costs, obviously, to buy assets outside of the euro area, then you would think that there should be some portfolio rebalancing, and you would have a lower relative to a scenario with no euro demand for non-euro assets by, in particular, euro area countries because of this diversion effect. So in the paper I was talking about, indeed, we do find some evidence for this diversion effect when we compare Nordic countries, so countries which we think are relatively similar, in the euro area, such as Finland, and outside of the euro area, such as Sweden, Norway, and Denmark. However, we find this diversion effect only for equity, not for bonds, and that may not be very surprising because, in fact, most of these countries which are still outside of the euro area actually issue a lot of their bonds in euro, which is not the case for equity. Okay, another question which I think is interesting in particular because it raises the larger issue of the future geography of financial markets is whether euro has benefited more the larger financial markets, whether this transaction costs effect, again with a very broad interpretation, has been more beneficial for investors in larger financial markets. And the short answer is yes. We do find that larger financial markets, and here again inside and outside the euro area, so it's not only financial markets inside the euro area which have benefited from lower transaction costs to buy euro assets, it's also the outsiders. Larger financial markets have benefited more, even more, from low transaction costs to buy euro-based assets. However, there's no UK specific effect. Some people have talked about UK gaining more from the euro than other markets. That's we find no UK specific UK effect. So, in terms of the implications, for example, for the geography of financial markets. Now, I have some papers with André on theoretical papers on these issues, and what we find is that in a world with economies of scales on financial markets, for example, simply because there are fixed costs to issue assets on different markets that would give rise to economies of scale, then when you have lower transaction costs, such as the one I was talking about, then what they're going to do is reinforce two things. Concentration towards larger financial markets, but here in and out of the euro area, not only inside the euro area, but also outside of the euro area, because in particular of what I've just said before about the extra benefit for larger financial markets. But also specialization, that's what we learned from any trade theory that would apply in this case, specialization, in this case in the euro area. And we see some of this already happening, both the concentration and specialization of different financial markets on different assets. Okay, so let me end up with some thoughts on the costs and benefits of this euro effect, which again is a very large effect. When you look at the effect of the euro on trade in goods, you do see an effect, but very modest. Here we do find very large effects, again, maybe too large to believe, and maybe in the future they will be reduced, but again, quite large and visible effects. Now, on the insiders, if you believe in this bias in favor of euro equity, this higher demand for euro equity should lead, everything else given, to a lower cost of capital for those investors inside the euro area. And this is the case if assets are imperfect substitutes, which we believe they are. For outsiders, the diversion effect, for which we have some result and some evidence, the diversion effect in this case should deteriorate financial terms of trade of those countries, because what that means is that to sell their asset, the relative price of their assets relative to the euro area assets should fall, and that's the negative effect of the diversion mechanism. For all, the fact that you have broader financial markets in the euro area, lower transaction costs, etc., should lower the cost to diversify risk. And that may be important, especially inside the monetary union, when you have asymmetric shocks, because in this case, financial markets, or broader, more liquid financial markets, may help insure against asymmetric shocks, on which we have had a lot of analysis. And therefore, an increase of the supply of risky assets in the euro area. now and finish on this point, which in a sense I was already making at the beginning. I think a few weeks ago, most economists would have said that, would have interpreted this increased supply of risky assets, more financial, larger financial markets as a welfare gain, but a few weeks ago is a long time ago.
It's a very long time ago indeed. We wish you the same fortune for your paper as the one of Andrew Rose, even though we may accept to have the final estimate to be revised down as Andrew did. So we move to the next paper by Linda Goldberg, who has been head of international research at the Federal Reserve Bank of New York, and now seconded to the Board of Governors. Linda, you have the floor.
First, I should extend my appreciation to the organizers for putting together a really fascinating program. When I speak today, I want to be clear. First of all, I want to be clear that these are my views and not those of the Federal Reserve Board or Federal Reserve Bank of New York. I want to be clear that there are different themes that we could talk about when we consider the euro, and what I'm particularly going to talk about is the extent of use of euros and dollars and those consequences, as opposed to talking about the value of euros or dollars, which are really very different concepts. The dollar continues to be the dominant currency of choice in international trade transactions. Now, I should say my mandate in coming up here was to talk only about the dollar's use in international trade transactions. To what extent are transactions, exports, and imports invoiced in dollars? But there's also extensive evidence about the extent to which dollars and euros are used in invoicing all kinds of international financial transactions. The biggest, most extensive developments have been in corporate bond issuance for international bond issuance for the euro's growth. But I'm not going to deal with the international financial transactions, and I would recommend to you an excellent report that the ECB puts out called The International Role of the Euro. The last one was issued in July, and it really provides very rich and extensive information on that. Now, in terms of international trade usage, we have seen the euro's role grow. It grew mainly from its inception through 2004. Initially, the growth in the role of the euro came about through its replacement of the legacy currencies in international trade transactions, then to the expansion of countries who were at that point in the periphery of the euro area, and now we see it's more of a European phenomena, but really hasn't extended as much beyond Europe. So, mainly it's used now as in transactions and not fully in transactions of countries with geographical proximity to the euro area. What are the reasons underlying dollar or euro use in any markets? If you look carefully at data across countries and over time, the key determinants of the role of either of these currencies in trade use are the issuing country I have in quotes, or region size, so the size of the United States, the size of the euro area, exchange rate regimes, so what's the system of how many countries have currencies anchored in one way or another to dollars or to euros. Transactions costs, Philippe mentioned some of this with respect to financial transactions, but costs of moving in and out, bid-ask spreads, for example, on financial markets matter somewhat, although it's not the dominant force at work by any means in which currency is used for export and import transactions. Macro co-movements also matter. I'll talk about that at length on the next slides. And basically, what I think we should all keep in mind is the result that when we think about the decisions that are made by producers, participants involved, for example, in exporting, there are two forces that dominate which currency they choose for their transactions. One force you can think of as a herding force. Another force you can think of as a hedging force. So now I'm going to go into those in more detail. And what I'll do in my remarks is conclude by noting that whatever currency is used for invoicing international trade transactions matters for a country's susceptibility to shocks and for country monetary policy effectiveness. So let's first talk about this herding motive. So think of an exporter deciding which currency he or she should use for invoicing international transactions. What ends up being a very important factor is that this exporter should do whatever its competition is doing. So in particular, what you want to do is stay close to the invoicing strategies of your competitors. So the idea is that you have to, when you contract a transaction, you set your prices in advance in some currency. And what you want to do is set your prices in a currency that's going to keep the demand for your products pretty stable ex post, so after the exchange rates are all realized. And what that also means is that there's an incentive that you know there are going to be exchange rate fluctuations, but you want to do something similar to what your competitors are doing, because after the exchange rate moves, you don't want your price to be so different in the destination markets than the prices charged by your competitors. So this herding motive or this coalescing motive in your invoice currency choice is going to be strongest among those goods and those industries where the goods are closest substitutes. And when shifting among suppliers is easiest. So you see this idea of herding or coalescing in currency choice to be really strong in commodity markets or in other industries where goods produced by different players are close substitutes for each other. Now, what about the hedging motives? There's been some academic literature that says that your invoice currency should be that currency, the currency of whatever country has the most macroeconomic stability. So just use the most stable currency. There is an element of that that's absolutely true, but really for the hedging benefit from your currency choice, what you want to do is look at the end of the day at your balance sheet as a producer. And you realize that your marginal revenues, your prices could be moving around, but your marginal costs are moving around. And the thing that moves these marginal revenue and marginal costs around are exchange rates and demand shocks and financial conditions and the like. So what you want to do is choose your currency in such a way that your marginal revenues and your marginal costs move together. So that's your hedging motive for currency choice. So you're going to look at the relationship between a particular exchange rate and the types of other shocks that'll be going on, in terms of changing your marginal costs. So basically, if you're going to be in a world where ultimately the price that you receive, your marginal revenues are going to be lower, you also want to choose your currency so that your marginal costs are lower. And then you have to look at what happens to your marginal costs when demand for your product shifts for different reasons. And that's elaborated in a paper that I've done. Okay, you also want to think about transaction costs for using your currency. Looking at the data and market activity, if you look at bid-ask spreads, which are one proxy for the transaction costs in foreign exchange markets, they're not an exact proxy. Bid-ask spreads still often generally favor the dollar. The exceptions where the euro is favored as a low transaction cost currency is in some euro area, broadly speaking, periphery type of country. So again, this geographic proximity comes into play. Now, as Philippe noted, there are these inertial forces that influence transaction costs, which is that if you have a currency that's extensively used and there's a lot of transactions, liquidity in that market, that's going to keep those costs low. Of course, it's possible that there's a shift in activity, so everything else moves from, just for example, the dollar to the euro or to some other currency, and that would upset transaction costs, this kind of balance of transaction costs, but that's kind of a difficult thing to accomplish. It doesn't just turn on a dime. Okay, so now, what about the dimensionality of this use? You can think about currency use and trade as divided among two dimensions. First is, let's think about the dollar as an invoice currency use, just in use for the example. Suppose the dollar is used on trade transactions with the issuing country. So that's somebody trading with the United States invoices in dollars. The second dimension is if a currency is used on transactions between third countries, so transactions that don't involve the United States but are still using the dollar. Now, the U.S. dollar is extensively applied in both of these roles. The euro, by contrast, is mainly still used in this geographical proximity, but not extensively used outside of the euro area. I have a couple of charts that go through the numbers on this. So how am I doing on time? Just
You are doing, okay.
halfway?
Couple of minutes.
So I'm not going to go through the numbers, but just to point out, the dollar is used on transactions with the United States. The dollar is used on like intra-Asian transactions. So in Asia, the dollar is the dominant currency. When we look at the euro area, the dollar is still used extensively on European transactions, about a third of the transactions outside of intra-European trade. And in the accession countries, or I'm sorry if I used the wrong terminology, but the other countries that are joining the euro area or have joined, this is an increasing phenomena. In terms of the euro use, again, I made this point about geographical proximity already. What are the consequences for policy? Let's get to the bottom line on some of this. Now, that first dimension of the international role of the central currency, whether it's the dollar or the euro, is pretty well understood. And the basic message there is that whatever country's currency is used, so be it the U.S. or the euro area, what happens is, for example, let's take the U.S. case. If the U.S. dollar is used for invoicing international trade transactions, you're going to see that prices of traded goods are relatively stable in dollar terms, and when the exchange rate moves, the prices of goods that are consumed move a lot with the exchange rate in other markets. So, for example, if there's a change in the dollar exchange rate vis-a-vis another currency, then that country's consumption is going to be adjusting a lot. The U.S. is going to see pretty stable prices and is not going to have to engage in the same type of price sensitivity as elsewhere because prices have not moved much in the United States. So in terms of inflationary consequences and the like, this all matters because a country with high pass-through of exchange rate movements into their own prices is going to have more sensitivity of their local inflation rates to exchange rate movements than a country that has lower exchange rate pass-through. And there'll be more expenditure switching and movement of their imports in response to those exchange rate movements. The second dimension, which is this intra-periphery use of a currency in trade transactions, and the consequences of that dimension for policy are less well understood. I have a recent paper that explores this, and I'll just go, in the interest of time, through briefly through a couple of main results. Again, terminology, apologies, it's not meant in any derogatory way. Think of a center country, think of periphery countries. In this case, take an example of the U.S. dollar with Korea and Thailand as being two periphery countries that extensively use the dollar in their transactions. The first thing to bear in mind is that the periphery countries, if they use the center's currency, the dollar, on international trade transactions among themselves, they're going to become more and be more sensitive to U.S. monetary policy, and their own policy will become less effective at influencing prices in their markets. The second result, again, I can expand more in the Q&A if there's time, is that whatever the center country does, so the U.S. monetary policy decisions are, that has externalities for the periphery. So, in general, we know what the rules are behind U.S. monetary policy decisions. We know what the euro area's approach is. But, if there are other countries that have different economic conditions, they're going to have their demand and their inflation rates moving around in a way that might not have been what they would have chosen otherwise. Now, this whole second dimension can actually be inefficient for third markets, and they could benefit from international cooperation with the center, but recognizing that if there is kind of a cooperative setup with the center country, that center country is going to have a loss of its own welfare by these criteria. So you'd have to have a world where the center agreed for some reason to have an explicit recognition of the welfare of the periphery. Now, you might ask, let me just conclude with a point about exchange rate pegs. So my last slide, which is, suppose there are periphery countries and they're using the dollar on their trade transactions. An exchange rate movement between the dollar and those countries we know might be kind of shifting the economic conditions in those countries around. Wouldn't it be better for those countries to peg against the dollar or the center country's currency? And in fact, in the simplified example and setup that I've talked about in this work, it doesn't actually end up being the case that pegs dominate more flexible currency arrangements. And the reason is that even if countries are using the dollar in their own trade transactions, when they have domestic monetary policy still as a tool at their disposal, they still have some ability to offset some shocks that they have domestically where they fully abandon that monetary tool when they have a peg. Now, there are lots of other reasons you want to keep a peg, but by this particular context, the peg is not the solution to the inefficiencies that come out from using currencies. So in conclusion, the dollar still is the dominant currency in transactions, international trade transactions. The euro has gained some ground. We know that key commodities and highly substitutable goods in trade are invoiced in dollars even within the euro area. Tipping is possible in currency use, but there would have to be very large shocks for this to occur. Thank you.
The euro will not manage to displace the dollar for none of the reasons already discussed. The reason the euro has been a huge success in its own league and in monetary terms, it continues to deepen its financial markets, all the things that we've talked about. But the euro remains a dwarf related to foreign policy and security matters, because Europe remains a dwarf related to foreign policy and security matters. And one thing that has come out of all the research that my colleagues have already been presenting is that there's a huge amount of unexplained variance in what determines the reserve shares held by central banks and what determines countries' pegging conditions. As Linda just pointed out, there are all kinds of decisions that go into pegging from an economically optimal point of view, but that doesn't seem to be the sole determining factor, as the literature shows us. Similarly, as Kristin pointed out in her great overview at the start, there are many different factors that can go into a currency choice, and she mentions that there is this financial one, but there we're sort of stymied in some sense because it's not sufficient. We don't see enough information there. My colleague Ted Truman and his co-authors have done a lot of work on this as well, that there's a huge amount of inertia and over-investment in U.S. reserves by major countries, a huge amount of countries who peg to the U.S. dollar who could just as easily, on a pure economic Mundell-Fleming type basis with geography and account, peg to the euro. So the question is, what is this missing mass? And what I'm going to argue is it's actually foreign policy and security matters that count. Now, that should not make everyone sit up and say, oh, goody. It, in fact, is actually a bad outcome from the world point of view, especially in light of recent events. If the U.S. and the euro were really on a par on solely economic basis, as they are largely getting to be, then one could imagine, as Barry Eichengreen has written about recently, a multipolar monetary system, some sort of smooth transition between countries and regions that have very broadly the same values and broadly the same concerns. If in the end the monetary dominance of the U.S. is concerned with security and foreign policy matters at least as much as with economics, once the economic basics are met, then we do not have a situation that promises a smooth transition or a pole that will be entirely that friendly if people get out of it. And that's where I'll conclude in a moment, in 9 minutes, why that might be worrying particularly now. I think it is worthwhile, and this is one of the premises of this conference, despite all the concern that people have had for good reason about recent events, and I promised my wife I would not look at my 401k for the next several weeks. But the bottom line is we know from past experience that financial crises do come and go. This may be the world's worst, certainly since the Second World War. This may be the most broad across countries, so that it's possible we're in totally different territory. But remember, Argentina is still with us. Financial crises come and go, countries survive. This is not the whole measure of the matter. What we do need to think about is why, when there's so many things that go for the euro, why there hasn't been a sudden uptick. Obviously on inflation, the US and the euro are similar. Obviously on trade, the Eurozone actually exports more, and as Linda mentioned, there is some geographic containment there, but if you try to run, say, a gravity model and explain it, there is a shortfall, as she implied. So how do we think about this? And I would argue it is the security side. So let me try to illustrate. I don't have a PowerPoint, but I do have a point. So let me try to illustrate with a couple historical examples, and research is underway trying to formalize this slightly more abstract concept. Think back to the golden day of yesteryear, the last time the U.S. was squandering its exorbitant privilege. So let's go back to the 1960s. At that time, as Giscard d'Estaing fed Charles de Gaulle the line, the U.S. exorbitant privilege consisted of issuing all this debt in its own currency to waste money both on military matters and consumption without discipline. Sounds familiar. In this case, we had a long, slow dissolution of the Bretton Woods system. Now, obviously, part of this was because people didn't want to give up the security of the Bretton Woods system, and it was hard to imagine. But part of this, Fred Bergston, as a junior State Department official, was, I think, involved in some of this, actually, was back and forth between the German and the Japanese and the U.S. governments in exceedingly explicit terms, leading to what the historical moment of the so-called blessing letter, where there was an explicit time made by the U.S. to maintaining troops in Germany on the Cold War front for Germany not taking too much money out of the gold pool, not taking too much money out of the dollar. The Japanese government, of course, was under similar pressures in very explicit terms. It is worth noting that the only country that really pushed hard for a loosening of this relationship during the 1960s was France, even though from a pure economic point of view, it had more to lose from importing inflation and from instability than Germany or Japan would have. But it, of course, at the time was trying to assert its foreign policy independence, and so was more interested in making noise at the expense of the U.S. Flash forward a few years, let's talk about 1992 and the Eurozone. As was stated very nicely by Lorenzo Benismaghi earlier today, the crises, the internal ERM crises of 1992 were a major factor in going forward with the Eurozone, and in our conference, the Euro at 5 years ago, Tommaso Padoa-Schioppa made much the same point. And coming from an Italian, of course, that has a certain credibility. But it is also worth noting that in 1992 was the first point at which Germany was seeing significant reductions in U.S. troops. Germany had been reunified, the Berlin Wall was down, And so the notion of a normalization of German foreign policy was out there, and therefore it was more credible and more possible to consider an independent monetary policy for Europe than it had been in the past. Look again to other examples. What is the one large place outside of immediate contiguity with the Eurozone that has extensive euro usage? It's the CFA franc zone. We're going to be lucky enough to hear from the governor of the Banque de France at lunch, and I'm sure he won't take the time to correct me because he has other things to say. But if you look at the CFA franc zone, you can see its membership ebb and flow through the years with the membership of the nation states in that zone in the security relationships. David Stasavage of the London School of Economics did a very nice history of this period. But there's a very explicit example. Take Mali. Take Mali, please. Mali exited the CFA franc zone in 1962 when it decided it wanted to have a military alliance with the Soviet Union. It was only readmitted into the CFA franc zone at a later date when it reversed course and took in French and U.S. advisors on its economy and cut its ties with the Union. Madagascar, Mauritania in the 70s went through a similar sort of thing. Right now, what is the one other place besides future members of the Eurozone that has occasionally used the euro, according to the ECB's definitive studies? It's the former members of the Republic of Yugoslavia. What is the one place besides Afghanistan that the European Union has troops outside of its immediate borders? The former republics of Yugoslavia. My colleague Anders Aslund had been writing about the Soviet Union at the time of the breakup, and you can find there, as other scholars have pointed out, there were a number of people recommending that post the Soviet Union, in the time of the Commonwealth of Independent States, given the trade ties within the Union, it would have made a great deal of sense for those countries to remain on a ruble peg, to remain in a currency union long after the political union. What you found was the countries that had the most to benefit from that peg, meaning the Baltics, were the very ones who stepped out of that union because they had the most sense of independence. The oil countries, the Kazakhstans, the Turkmenistans, and so forth, who actually had the most to gain by exporting to world markets and getting out of the distortions of the Soviet zone, were the ones who stayed in the ruble zone for the longest because they had the closest ties to the former Soviet Union. So where does this leave us? If I'm right, and obviously I must be, that was a joke. We are sitting in a situation of great turmoil at the moment. We are sitting in a situation where we are seeing flight to quality, and flight to quality still remains the dollar, still remains the U.S. Treasury market. And this is not for any economic reason. As was pointed out several times today, and as pointed out by Philippe, as well as Kristin, as well as Lorenzo, that the financial markets in Europe are doing reasonably well in terms of depth and efficiency. And right now, as much as I agree with the points made about corporate governance that I think will come out to save the U.S. economy in the end, there is no particular a priori reason why people should be, in third markets, flooding into the dollar. The sole reason is that the U.S. remains the foreign policy leader and thus provides relationships. Can you imagine a Taiwan, a Japan, a Saudi Arabia, a Panama, deciding one day, oh, for economic reasons, it might be more optimal to get out of the dollar peg? Not only would they have a visit from whoever's sitting at the NSC, they would also find themselves in a little bit of governmental instability. So where do we go from here? I worry a bit that, as I said at the start, I would be happier with a world of bipolarity between euro and dollar, and I think in many ways the Eurozone has done everything it could to get itself to that level of parity. But as with so many other things in the economics of the Eurozone, they're limited by their political nation-state divisions. That remains a check on the foreign policy of the Eurozone, of the European Union as a whole, and thus, at this moment, if the Americans blow it, fail to respond to the crisis we're now facing, and do not create an international institution, then we have a Chinese peg to look forward to, along with Chinese security rise, and that, as some of my colleagues have discussed in the past, is not the most comforting of scenarios. So, thank you very much.
Thank you, Adam. So, to summarize, in order to For the euro to have a chance, you should transform the M of monetary union in M of military. Until then, we have no chance. Now you come, André. It's just your turn. Okay, we have André Sapir presenting a paper together with Jean Pisani-Ferry. André at the Université Libre de Bruxelles, CPR, and Bruegel. Please.
Thank you. Thank you, Marco. Now, I'm not going to address which of the possible factors is the most important factor that may explain the relative roles of the euro and the dollar. We have heard several candidates, and we have just heard a strong pitch, in particular for one. I'm not going to give a strong pitch in favor of one. I'm just going to look at an additional one. I think that there's been general agreement today that the euro has become a very important currency. It's second. It's clearly remains second to the dollar. It's much more, indeed, as Linda put forward, much more regional than a worldwide currency. And there is indeed also the case, which has not yet been made, that the ECB itself has an official doctrine which is neither promote nor hinder the international role of the euro. That itself must play an important role, certainly, in this development. Now, I think what is indeed more interesting is to look forward into the future, and there have been different views. One view is that indeed there is and there will be a considerable amount of inertia based on network externalities in favor of the dominant currency, the dollar. Then there's been this revisionist view, of which we've seen many papers come out recently, especially for the last 1 year, saying that, yeah, there is some inertia, but it's probably much less than one think, and developments could change very, very rapidly, and the euro could even displace the dollar in 10 years' time or whatever. And then, indeed, now we have Adam telling us, no, there is a major flaw for the euro's role in the international arena, which is the geopolitical fundamentals. Now, what we do in this future paper is to look at another political dimension, which is more the domestic political dimension rather than the geopolitical, but obviously they are related. It's the matter of governance. Now, what we are discussing in the paper is, number one, selected evidence on the international role. I'm going to skip over that. Obviously, we have heard enough of that. Then I'm going to try to make the case, why is governance really an important matter when it comes to the euro? And I'm going to argue that there are some problems with the governance, and I'm going to see whether it may change, and if so, what may be the consequences. Now, I think we have heard already why governance is a matter, in particular, for the euro. As it's often said, Padovsky said that the first, the euro is a currency without a state, or more precisely, it's a currency with several states. And that is clearly a potential problem, the fact that we have, on the one hand, a single monetary authority, and then we have national, political, fiscal, regulatory supervisory authorities, and much of the discussion this morning has been about this division between the common central bank and the national political, fiscal, regulatory, and supervisory authorities. Now, when it comes to governance, and one has to try to understand how it fits into the international role of currencies. Probably governance always matters, but it's clearly not the only factor that matters as to whether or not a currency is attractive. And one has to look at, and we have heard that already, it's attractive to whom? A currency international role is both vis-à-vis the private markets, but also vis-à-vis governments. And this is the discussion we just heard with Adam. It was sort of more the government, the choice of pegging. But then we heard in previous presentation about the choices by the financial market. So one has to look at, how governance may influence one choice in the markets, one choice by governments. And then there's the issue of attractive when. The main point that we are trying to make in the paper is that one has to distinguish normal times, and one could say that the first 10 years of the euro up to a few months ago were normal times, calm times, and then probably governance is not the most important factor in determining the role and how far the euro made progress on the international scene. There's much more fundamental economic issues. But then in crisis times, and there can be different crises, they can be domestic crises, they can be the financial crisis, but they can be foreign crises related to foreign currencies, then indeed the matter of governance may be much more important. Indeed, it is crucial for the ability of the currency to play an international role. So that's the matrix. I'm not going to, in the interest of time, I'm not going to go over the matrix, but the matrix is really to make the distinction between the role of a currency vis-à-vis the markets, vis-à-vis private parties and vis-à-vis governments, and the respective role of governance and fundamental economic issues, and then make the distinction between normal times and crisis times. And the rest of my presentation is going to say, first of all, well, in normal times, indeed, governance is just one of the factors. And then one may have questioned, and a number of people did, how well the euro area was governed, was equipped in order to handle the problems, even in normal times. What about the monetary policy? What about the credibility of the fiscal policy? What about the kind of macroeconomic policy interventions? And I think there would be wide agreement as one looks at the performance of the euro area in terms of monetary policy, even in terms of fiscal policy, and certainly by looking at what has happened in terms of inflation, in terms of interest rates, one can see certainly, and again, I'm not going to go over those charts that are a little too long, maybe just, the inflation expectations, certainly, if one compares the EU to the US, this comes from a recent a study published in September by the BIS Quarterly Review that looks at new measures of inflation expectations that shows that indeed the euro, in a sense, outperforms the dollar on those grounds. So I think in general, if you were to look at the worries that one had about the governance, how the system would work with one central bank and a number of governments, a number of fiscal policies, I think it has delivered certainly very well. Now, I can't resist, since we at Bruegel, Jean and I, together with Philippe Aguillon, with Marek Belka, who is now at the front, with Jürgen von Hagen and Lars Eckenstein, we also did a study trying to, try to draw the lesson of the first 10 years of the euro. I can't resist quoting from our report, where we said that, look, the euro policy framework has worked well, but a policy framework, and I just quote, a policy framework should not only be judged by its agility in fair weather conditions, but also by its resilience in storm conditions. In bad times, the ability to convey relevant information to the ultimate decision makers, to prevent conflicts of interest from obscuring choices, and to ensure swift decisions are key properties that depend on the system's design. In this respect, it should be recalled that in a global perspective, the last 8 years, no, last 10 years, have been benign. The policy framework of the euro has thus not yet been tested under stress. It remains to be seen, and the report came out in January of this year, it remains to be seen how well EMU is set up to deal with events like disruptive global shocks or internal crises. So there we are. Now the test is indeed in front of us, or we are in the middle of it. Now, I'm not going to discuss the issues of external matter and the pegs. I think this was the subject of Adam's discussion, and I think we could agree on much of this. So rather, let me focus on the domestic, on the financial crisis, and which is a global, not a domestic, a global crisis, but how it's being handled from a domestic viewpoint. I think we have heard today very much what is on this slide. Certainly, the liquidity provision went very well, and the ECB was ahead of the Fed in this game since August of last year. So certainly on those grounds, monetary policy, ECB, liquidity provision, in crisis time, strong marks for the ECB, certainly not less than for the Fed. Certainly, we have the problem in Europe of lack of supervisor. and this may still haunt us in the coming weeks. And we have seen, and we have heard Commissioner Almunia tell us, well, look at what has happened in the Benelux countries with Fortis, with Dexia, with Belgium, France, and Luxembourg in September. Things went very well. They were able very quickly to resolve the problem in ad hoc cooperation. Although a week later, we saw that the solution between Belgium and Netherlands on Fortis unfolded, and the Dutch pulled back their resources, and we have now two Fortis, a Dutch Fortis and a Belgo-Luxembourg Fortis. There's not anymore a Fortis. So the solution looked good one week, a week later, much less good. Now, the challenge that is ahead of us, as we have heard already, is that, yes, there may be a need for an EU strategy to address potential negative spillovers. I think by now there is general agreement that any strategy must be three-pronged. There must be recapitalization, there must be removal of the toxic assets, and there must be guarantee on liabilities. Now, in the euro area, I mean, it's a problem. We have heard Dominique Strauss-Kahn tell us those are global problems and they need global responses, but they need even more probably responses inside Europe, because the potential negative spillovers are that much bigger because of the cross-border banks and because of the capital mobility, which is perfect inside the European Union. And at the same time, we know that we don't have any supranational EU fiscal authority, and something which is not much discussed but cannot be forgotten is that they're still national champions. And when the hard times will come, there will be difficult solutions to be found for the cross-border banks. So even though they are cross-border, it doesn't mean they don't have a nationality. And it doesn't mean that they are not felt as being national champions someplace. And that will have to be dealt with. And I think it's not going to be very, very easy. Now, certainly, given those constraints, we cannot have an EU strategy in the form of an EU fund, of pulling together a fund to either recapitalize, to purchase assets, or to guarantee bank liabilities. That's just not on the cards. However, clearly there are considerable risks of regulatory arbitrage between member states if nothing is done. So one has to walk this tight line between the fact that we have different authorities, and at the same time, there can be tremendous amount of arbitrage inside the EU or the European Union, the euro area, as we have seen in the case of Ireland. Now, Commissioner Almunia reminded us this morning that only 3 days ago, EU finance ministers came up with a plan, and the plan was essentially that member states are free to do what they want. They are free to recapitalize banks. They are free to purchase assets of the banks. They are free to provide guarantee. However, they should abide to a number of common principles. Timely and temporary support, protect taxpayers and let shareholders essentially bear the brunt. Governments should be free to change bank management and remuneration scales, but they need to respect EU state aid, and they should not be negative spillovers to other member states. The very same day, the UK announced its recapitalization plan with amounts of between 32 and 46 billion euro, and Spain announced its own version of the Posen plan with about 30 to 50 billion euro. And then the next day, that's 2 days ago, UK announced a full-fledged plan, which is not just about recapitalization, but indeed about the three-pronged strategy that I discussed before. So in a sense, you could say, well, the decision that was taken at ECOFIN on Tuesday is realistic, not very ambitious. What does it lack? Well, it lacks certain important ingredients. In particular, there is no agent in the system that has been really appointed in trying to coordinate all the actors, what some people have referred to sort of as a crisis committee, in order to ensure that indeed there would be rapid recapitalization of cross-border banks. And it's very surprising, maybe the leader who has emerged from this in Europe is is golden brown. And this is a theme that I'll come back in the conclusion. This issue between the euro area and the EU in general, where exactly is the split? And I think that's a major issue. Now, there's clearly been no decision on any solidarity. I mean, clearly recapitalization may be beyond the ability of some of the small member states. We may have banks that require too much state money compared to what certain small states would provide. Would there be then solidarity? Well, one doesn't know anything about it. And as far as the Stability Pact and the level playing field competition rules, Commissioner Almunia told us that indeed the Commission is putting forward ideas and that their progress is being made. Now, just before concluding, let's ask whether euro governance in crisis time can and will change. Now, clearly, the next few weeks will be crucial for the credibility of EU and euro area agent, for the Commission, for the Eurogroup, the ECOFIN, as the agent of the common good. And one question that we are putting forward: what exactly the Commission is going to be doing? Is it only going to be ensuring that there is level playing field about state aids, about the Stability and Growth Pact, or it goes beyond that, in the more strategic role? Or is this strategic role really what the Eurogroup or perhaps the ECOFIN is going to be doing? And this is about really taking the role of coordination in this three-pronged action. Now, after the crisis, are we going to be seeing finally a supranational supervisor? Now, the question of the supranational supervisor is that clearly it cannot be, as we have seen, it cannot be only a supervisor for the euro area. It cannot leave the UK outside. It makes no sense for the system. So we must have an EU. It's an EU-wide issue. It's not a euro area-wide issue. And there are a number of issues that need to be resolved. In particular, extending it beyond banks. So I just come to the last slide, and coming back, therefore, to the implication of all this for the international role of the euro. Clearly, as I said at the beginning, the euro is a currency without a state, and there's not going to be a euro area state tomorrow. And as Lorenzo told us, well, this decentralized system can work very well, and it has worked very well, as long as we were under fair weather. The open question is, what about the crisis? And as I said, we will see, and I think this is essentially the point that Lorenzo Binismaghi was making. We shall see in the coming weeks whether indeed the apparatus that we have is sufficient. I think there's been much too much for our taste. There's been much too much effort at improving the governance at normal times, looking at rather minor issues and not sufficient strategic decision about how the system would be capable to react in crisis time. One of the difficult issues that we are faced with is this awkward division of labor between the euro area and the EU. The euro area, with the European Central Bank, as I said, is clearly capable, as we see, to act in a crisis time in terms of liquidity. On the other hand, many of the important issues that relate to crisis for the moment on the political side go beyond the euro area. And indeed, because of the particular role of the UK in the system, and there it needs to be at the EU level. So I leave it there with this issue of this awkward division of labor, and I think we don't have really an answer to that, but we have seen that indeed the UK has played such an important role in not only in terms of putting forward ideas, but because of the particular role of London and the UK financial system. So that needs to be certainly taken into account when we want to reform the governance system, which we believe is needed. Thank you.
Thank you, André. Thank you. I think as we had a very stimulating panel. I mean, in the interest of saving on transaction costs, I would not call the presenters here at the panel, but I'll open the floor for questions. And I think you raise up. You are all there on the first table. I mean, to the very last comments by André. I think it is fair to say that when we did our work on the MU10, when you did the work on coming to age, we had a different interpretation of bad times. We were not thinking about this. We thought about maybe a quite sizable shock, a recession, one of these more cyclical type of events. Not this, and I think. Testing governance under extreme stress as now is really the acid test for this. I think in terms of let's say in more economic terms, I think what we have come I think to see in these very days is that I mean EMU, you remember, solved the inconsistent trio going back many years ago. Between free capital mobility, fixed exchange rates, and independent monetary policies is solved by fixing the exchange rate for good. I think what we are seeing now is really another inconsistent trio, which is a single financial market, diversified supervisory authorities, and different or separate fiscal authorities. I think we have to. I mean, out of this crisis, we have to solve this inconsistent trio. Otherwise, I think we are not going to be. Maybe are not going to be able to come out of the crisis, let alone tackle effectively the next one. So we are running behind schedule badly, so I take just a few but very sharp questions, please. And introduce yourself so that...
My name is Kenneth Dam, and I want to ask Mr. Sapir to elaborate on why he believes the EU, or the regulatory authority, has to be EU-wide. To replace, for example, the Bank of England in its regulatory activity, or the FSA in England. We're now dealing with a financial crisis. I don't see the necessity of, I see the necessity for a Eurozone regulator. I do not see a necessity for the financial crisis to have that include non-Eurozone members. In fact, I don't see how it could work.
There are some consent to your... let's take another couple of questions. Okay, please.
Run up to the creation of the euro, there was a great deal of fantasizing on the continent about the way that financial markets would move to Frankfurt and Paris. It didn't happen. The UK stayed out of the euro. The UK's economic performance has consistently been better than that of the Eurozone for the last 10 years. Over the 10 years, the City of London has actually gained its share of financial markets, including euro-denominated capital markets, has actually increased its share of the market. And Kenneth Dam is absolutely right. Why on earth would the British, now we were accused this morning of wanting to be competitive, and I own up to that sin, why on earth would we want to volunteer to become regulated and supervised by the same people that brought us the 35-hour week? I don't get it.
The 35-hour week is being reformed, I understand. I'll take another question. Please.
Yeah, my name is Richard Erb, and my question would be to Kristin Forbes and Philippe Martin on the mic on now. Okay. The presentation by Kristin Forbes and Philippe Martin I found very interesting, but what surprised me was that neither one mentioned exchange rates. And I guess I would put that question as to why no mention was made of exchange rates in their analysis, and what impact taking into account exchange rates would have, for example, on some of the comparisons that they make, particularly given the very wide swings in the dollar-euro rate.
Okay. Thank you. I think we have to stop here with the question. I'll give the floor for 30 seconds to each one of the panelists, so they can answer the questions and maybe make comments on the other panelists. André, you go ahead.
Okay, let me just address Kenneth Dam's question. Good question, excellent question. I think maybe I should have been clear. Number one, this discussion about supervision that there is now in Europe only concerns a small subset of institutions, only the cross-border ones. Okay. So to the extent that indeed the UK is also, like everybody else, involved in cross-border banking or in general financial institutions, I mean, I think there should be no reason, and I don't think they will be. My feeling is that this reaction, this very strong reaction that you have, is a reaction of the past. It's a reaction of the past, I believe, not a reaction of the future, not a reaction post-crisis, it's a reaction pre-crisis. I think this is what the events will prove. And number two, one is only talking about supervision. This is really the matter. Now, my colleague at Bruegel was, put forward some ideas on this, Nicolas Véron. I think very realistically said, well, where should we put such an institution? Probably London. I mean, this is what, we have the European Central Bank in Frankfurt, and that has symbolic value. I think it would have equally symbolic value to have this EU-wide, not euro area-wide, this EU-wide supervisory body for the cross-border financial institutions in London, which is indeed the financial center of Europe.
Okay, thank you. Adam,
just two quick points, if I could. On the exchange rates, including the exchange rates, I must admit I'm a little confused. Is it the level of the exchange rate you think should have been included? Is it the volatility of the exchange rate? What does it mean to say there's an advantage for the euro versus the dollar, given that there's a huge volatility between the euro and the dollar? I mean, that's why those things are not included. It's not something that you can step outside the exchange rate relationship and say. That's why we do resort to things such as some of my colleagues put up when they did have nice PowerPoints about the convergence and inflation expectations, about the various measures of volatility. And in all those measures, there's always the question of what's forward-looking, but that the U.S. and Eurozone are actually very comparable at this point. Just a second thing to my friend Ken Dam, our friend from Standard Chartered, I'm not going to go all the way as far as André, as perhaps I should not, but I have to stand up and say that not all Americans are at this very moment prepared to go walking around the world confidently saying that London and New York's position will be unchanged by the last month's events. They may be in the end, and if they are, it may well be because of the failures in other places, and it may well be vulnerable still if we do not make necessary changes. But I think it is a little too soon for all of us to be sitting here and suggest that, oh God, if we had too much European regulation, we'd really be in trouble. There is a plausible case to be made that certain failures in regulation and supervision in the U.S. did play a role in this crisis, that part of those were because we did diverge from international norms. We thought that that was a good outcome. It seemed to be, but a lot of it will depend on what our productivity data and our GDP data are ex post 3 years from now. And I'm not saying I expect that to show us to have been wrong, but I'm saying I'm not yet ready to pretend that that's a closed issue. And I think, not suggesting you were either, of course, but I think we should at least have on the table, that's part of the reason we're having a Euro conference, is because there is more than one way to do things, and there is not a monopoly on the right model right now.
Thank you. Give the Jean for a few seconds, please.
Comment on Adam's very interesting points about the role of security and the attitude implicitly of the U.S. authority vis-à-vis the exchange rate regime of other countries. In preparing the paper with André in the first phase before the crisis really came to Europe, we looked at the crisis elsewhere and asked ourselves, do we have any evidence of a different treatment of countries in crisis depending on the exchange rate regime and to which currency they were pegged? And we didn't find any evidence. So it seems to us, I mean, just a note of caution, that this link between how a country would be dealt with and its choice of an exchange rate anchor is not that obvious.
Okay.
I have to say one thing about that. Don't turn the mic on.
The one thing is that some people might have a different interpretation of Mexico in 1994 from that perspective.
Okay. I think violating with the rest of the speakers, I think I will close this session, which has been, interesting, a bit outside the box with some imaginative proposals that you may want to take home or not. And with this, I think we can move to the next, immediately to the next session. Jean, please come to the stand.